Hello everybody and welcome to my Market Mechanics Masterclass. This video is only a complementary piece of the liquidity trading module in this series and is intended to provide a short, practical guide to trading liquidity. I do have a comprehensive written work that this video is based off of, and it contains everything you truly need to understand about liquidity-based market movements, which is critical to becoming a successful trader. When you're ready for the advanced material, go to the link in the description below for the comprehensive written work. I urge you to be diligent in studying the entirety of this module because I've carefully crafted each section to provide maximum benefit to you. So without further ado, let's get started. Please pause the video and carefully read and understand this not financial advice disclaimer. Moving on. We'll begin the practical guide here with the most important point of the liquidity trading module. That is, market movers need extremely liquid markets. These are the market participants that have so much capital that they are capable of moving the markets. To put it another way, they run the show. Think trading firms, hedge funds, exchanges, and billionaire independent traders. If you're familiar with the FTX and Alameda collapse, you know about the effects market movers can have on the markets. In the image here, you can see FTT losing 95% of its value because FTX was forced to liquidate their holdings and there was nobody willing to absorb the selling pressure. Additionally, Solana was caught up in the mix and suffered a significant drawdown as well. Moving on. A retail trader is anyone who is trading their own money rather than trading for an institution. As long as retail traders can identify areas with high liquidity, they can predict with a higher probability where market movers plan to participate in the market. Although market movers try to hide their presence as not to be front run or counter traded, they can't avoid leaving behind signs of active market participation. With this knowledge, retail traders can determine when and where market movers are likely to participate and can monitor those areas for signs of activity. This allows retail to trade alongside institutions rather than becoming their liquidity. In this practical guide, I will only be looking at two ways to identify liquidity in the charts. And the reason is because these two methods are so incredibly reliable and effective. First, I'll use price action artifacts to predict where market movers can participate. And second, I will add high volume nodes to the price action method to give you a truly powerful strategy, which will show you where the biggest traders are capable of participating. To start off, we will look at trending price action. Price action trends higher with a series of higher highs and higher lows. And the opposite is true for downward trending price action. When market participants continue to step in at each low, preventing price from breaching the previous low, a cascade of liquidations and stop losses is created to the downside. This happens because at each higher low, the traders who formed that low generally place their invalidation below their entry. So it might look something like in the depiction here. At this point, a market mover has two reasons to push price downward toward those stop losses. Either they have already filled their short positions, or they intend to enter a very large long position and they need to generate sellers to buy from, or both. When price moves downward and begins hitting stop losses, traders still in their long trades are forced to sell their positions and possibly liquidate their accounts. This is equivalent to opening new positions in the opposite direction. So in this case, it would be as if new shorts were opening. And we can see that here in the next image. This creates massive sell pressure as each long is forced to exit at whatever price they can get. But because most of the buy-side market participants are currently being forced to sell, there aren't many buy orders below to absorb the cascade of sell pressure. This results in a very quick move to the downside and generates enough liquidity via desperate sellers for interested market movers to fill their longs and flip their shorts if they so desire. Moving on to ranging price action. Ranging price action generates liquidity to both the upside and the downside in similar fashion to trending price action, but without the cascade. Longs are placing their stop losses below the range, and shorts are placing their stop losses above the range. When stop losses at the top are triggered, which is equivalent to new longs entering, larger traders suddenly have enough liquidity to fill their short positions. Conversely, the opposite is true for stop losses at the bottom of the range. In this case, price first moved up to take topside liquidity. Notice that the move upward formed a series of higher lows within the range. To a beginner trader, this situation would look like a double or a triple bottom with a bullish change of market structure and a breakout. But this created a cascade of stop losses like that in the upward trending price action example. And below the series of higher lows was a final pull of low side range liquidity. So after triggering stop losses to the upside, the subsequent move downward was very quick. Moving on to contracting price action. Contracting price action can trend upwards, downwards, or move sideways like a range. Upward and downward contracting price action generates liquidity in the same way as uptrends and downtrends, but sideways contracting price action generates liquidity to both the upside and to the downside, and generally results in a much more volatile and unpredictable breakout than a range due to the cascade of stop losses on both sides. Oftentimes, price will whipsaw both to the upside and to the downside, taking out all traders in the area, and we can see that here in the next image. You can see price first moved to the downside liquidity and moved back up to continue forming lower highs. After some time, price broke through the downtrend and moved into the liquidity above. Now when we bring all of these examples together, like in this next image, you will see why it's so critical to understand how to identify liquidity in the charts. And here we have the whole story. Many traders would view this as choppy and untradable price action, but liquidity is fundamental to how markets operate and will be the determining factor for where price goes. This concept is so critical to understand as a trader, and attempting to trade without that understanding is like gambling or trading with the blindfold. Moving on to high volume nodes. High volume nodes are areas in the chart where there has been a relatively large volume of contracts traded in the past. These areas act as magnets for price because this is where market participants have historically been most active, and price tends to revisit these areas. In particular, this is where market makers have injected the most liquidity to fulfill the demand for orders on both sides of the market, thus reducing the spread and slippage for traders. Consequently, large traders are incentivized to participate in the market at these areas. A common tool used to identify high volume nodes is the volume ranged profile. In the image here, a fixed ranged volume profile tool is pulled from the top of the downtrend to the current bottom of the downtrend to reveal two clearly defined high volume nodes. Moving on. When price action forms a trend or a range in such a way that liquidity is generated in an area of historically high volume, market movers have the opportunity to participate at a significantly reduced cost. In this example, price action did exactly that. It formed two swings to the high side and two swings to the low side, with a high volume node just above the upside moves. And because of the section on price action artifacts, you can see why large traders would target this high volume node for short entries. Subsequently, price moved upwards and triggered the stop losses that short traders placed in the high volume node, and then moved down and out of the range in search for the next consolidation zone. This sums it up for the use of high volume nodes in combination with price action artifacts to determine where market movers are likely to participate in the market. This is the end of my practical guide to trading liquidity. Please follow up by going to the comprehensive written work with the link in the description below. It has everything here and more, including heat maps, off-chart liquidity, time-based liquidity, and much, much more. If you have any questions or feedback, or just want to learn more, you can join my Discord channel using the link in the description below. This is also where I post exclusive trade ideas and help others become successful traders. I will be coming out with more material for my Market Mechanics Masterclass, so stay tuned and follow my social media for updates. If you found this guide helpful, it would really mean a lot to me if you left a comment here or tagged me on Twitter letting me know exactly what you liked. Don't forget to like and subscribe so you can stay up to date on my latest videos, and it will really help this guide find other traders just like yourself.